Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at energy fuels.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, imagine looking at a company's financial statement and just seeing this $100 million crater.
Right, yeah. Your first instinct as an investor is usually just to run in the opposite direction.
Exactly. I mean, if you're trying to build wealth and you do a quick glance at Energy Fuels 2025 financials, your immediate reaction might be to flinch.
Oh, absolutely. You're looking at a net loss of $86 million.
Yeah, $86 million. And an operating loss of $101 million. On paper, it looks like a giant red flag.
It does, but when you actually look at the operational data, a completely different narrative emerges. This is a company undergoing one of the most aggressive strategic transformations in the industrial sector right now.
Right, and that broader context changes everything about how you interpret those losses, doesn't it?
Yeah, totally. What you're seeing on that income statement is not some flawed business model that's just hemorrhaging cash. It's the raw, upfront cost of a monumental pivot.
Because they're transitioning, right?
Yeah.
From a pure-play uranium producer.
Exactly. They are actively transforming into a highly diversified, critical minerals powerhouse. Those 2025 financial hits, that's the direct result of really heavy, aggressive capital investments.
So it's all going into expanding their rare earth element capabilities.
Yeah, they're literally physically rewiring their infrastructure to process completely new materials.
Taking a step back, this feels like a classic scenario of confusing capital expenditure with, well, operational failure.
That's a great way to put it.
It's like looking at a massive commercial construction site and complaining that the building isn't generating rental income yet. I mean, the foundation is still being poured.
Right, and a transition to commercial rare earth production is notoriously capital intensive. Building these complex chemical separation facilities just burns through cash.
Which brings up the most critical wealth-building question for you, the listener. How does a company fund a pivot this massive without, diluting its shareholders into oblivion or just going bankrupt?
Well, that points directly to their underlying uranium operations. Even while they're executing this massive rare earth pivot, the core uranium business is producing at a remarkable clip.
Yeah, the numbers are wild. In 2025, they actually exceeded their production targets by 11%.
Right. They churned out 1.72 million pounds of uranium.
And that highly functional base of operations is the financial engine driving this entire transition.
It is. But the strategy they're employing with that uranium is arguably more fascinating than the actual production itself.
Because they aren't just selling it, right?
Exactly. They aren't mining that 1.72 million pounds and immediately dumping it on the open market for whatever spot price cash they can grab today. They're intentionally stockpiling it.
Yeah, they've built up this massive inventory of 2.0 million pounds of physical uranium.
It's huge.
I really look at that 2 million pound stockpile as like a coiled spring of stored revenue. They're operating almost like a central bank holding physical gold reserves.
That's a perfect analogy. By keeping that inventory on the books rather than selling it, they retain total strategic flexibility. They can wait for optimal market conditions.
Right, so if the spot price spikes, they have immense leverage to capitalize on it instantly.
Yeah, and the 2026 guidance confirms this aggressive posture. They expect production to ramp up to between 2.0 and 2.5 million pounds.
With sales targets set between 1.5 and 2.0 million pounds. But here is the critical security layer. 750,000 pounds of that are already locked into guaranteed contracts.
Which is huge for stability. Those contracts provide a guaranteed cash flow floor, and that is absolutely essential when you're funding high-risk expansion projects elsewhere in the business.
Right. Furthermore, you really have to understand the operational execution at the mine level. Management has driven their uranium production costs down to roughly $43 per pound.
And in the commodity mining sector, survival is dictated entirely by your margins.
Completely.
By pushing that cost basis down to $43, they ensure their core business remains a cash generator, even if global commodity cycles get super volatile.
I mean, if uranium prices were to drop to, say, $60 a pound, a lot of junior miners would just immediately become unprofitable.
Oh, they'd be wiped out. But Energy Fuels would still be generating significant free cash flow. They've engineered a formidable shock absorber into their daily operations.
But even with those healthy margins and that stockpile of stored revenue, building a rare earth empire still requires a staggering amount of liquid capital up front.
Oh, yeah. Billions, potentially.
Which brings us to a major financial maneuver detailed in their 2025 filings. The company raised $700 million through convertible notes.
Now, for anyone managing their own portfolio, hearing the phrase convertible notes usually triggers a massive alarm.
Oh, definitely. It's debt that can later be converted into shares of the company.
Traditionally.
That implies future share dilution, which puts downward pressure on the stock price.
Right, but when you analyze the unique mechanics of the mining industry, this specific capital raise actually functions as a massive structural advantage.
How so?
It's all about liquidity and survival. Because of that $700 million raise, Energy Fuels is now sitting on a working capital position of $927 million.
Nearly $1 billion in working capital.
Exactly. In the mining industry, the biggest risk to any capital-intensive transition isn't really the engineering, it's the valley of death associated with solvency.
Ah, right. Companies attempt a massive pivot. They run out of cash halfway through building their new processing facilities.
And then they're forced into bankruptcy, or they have to take on highly predatory financing. This near-billion-dollar war chest completely neutralizes that existential threat.
It's basically the ultimate insurance policy. Yes, those convertible notes will eventually put pressure on the overall share count when they convert to equity, but the sheer scale of this liquidity buffer gives them the absolute certainty of runway.
Exactly. They have the capital to actually finish building their rare earth separation circuits without constantly going back to the market to raise funds at unfavorable, desperate terms.
Okay, so they have the coiled spring of uranium inventory, and they have a fortress balance sheet. But having cash in inventory isn't a competitive advantage on its own. Any well-managed company can hoard cash.
Right. The real question is what they are building that creates an irreplicable moat.
And the physical manifestation of that moat is the White Mesa Mill in Utah.
Yeah, to understand Energy Fuels, you really have to understand the unique nature of this specific asset. It is the only fully licensed and operating conventional uranium mill in the entire United States.
And it boasts a capacity of over 8 million pounds of uranium per year.
It's massive, and getting a new conventional uranium mill permitted, environmentally cleared, and built in the U.S. today is, well, it's virtually impossible.
Yeah, you'd be fighting decades of environmental litigation, navigating the Nuclear Regulatory Commission, the EPA, local zoning boards.
Not to mention requiring billions of dollars in initial capital. The regulatory barriers to entry are just so astronomical that White Mesa operates as a true monopoly asset.
But the entire narrative of this company is shifting right now because this mill isn't just processing uranium anymore.
Right. They are upgrading the facility to support commercial, mixed, rare earth carbonate and separated NdPr output.
And for anyone who hasn't looked into electric vehicle manufacturing recently, NdPr stands for neodymium and praseodymium.
Right, and these are the rare earth elements essential for creating the ultra-powerful permanent magnets used in EV motors and wind turbines.
Those magnets are essentially the backbone of the global energy transition. But the market recently hyper-focused on an even more specialized announcement.
The terbium news.
Yes, terbium. Energy Fuels achieved the very first U.S. production of 99.9% pure terbium oxide.
Which is incredible. Terbium is a heavy rare earth element, and it is exponentially more difficult to process than light rare earths like NdPr.
It requires incredibly complex solvent extraction techniques, right?
Yeah, cascading series of chemical baths that require precise pH levels and exact sequencing, just to separate elements that have nearly identical atomic weights.
And the practical application of terbium is what makes it so critical. While NdPr creates the magnetic field, terbium is added to the magnet to prevent it from losing its magnetism at high temperatures.
Exactly. If you have an electric vehicle motor running hot or, a guided missile system experiencing extreme friction in flight, you absolutely need terbium in those magnets or the system fails.
Wow. And up until this announcement, the processing of high-purity, heavy rare earths like terbium has been controlled almost entirely by China.
Yes, almost 100%. By successfully producing this domestically, Energy Fuels has basically become the only Western company possessing a complete mine-to-oxide supply chain for heavy, rare earths.
That geographic shift represents a total paradigm shift for global supply chains.
It does. The U.S. defense sector and the broader clean energy industry have recognized the severe vulnerability of relying on a primary geopolitical rival for these materials.
Right, the materials required to build advanced weaponry and power infrastructure. And Energy Fuels is actively stepping into that void.
They're no longer just selling a mine commodity, they're literally selling national security and supply chain independence.
And the financial models reflect this pivot. I mean, projections for the Phase 2 expansion of the White Mesa Mill show a net present value of $1.9 billion.
1.9 billion. It points to an earnings potential that completely eclipses their legacy uranium operations.
If we look at how the market is reacting to this fundamental story, a profitable uranium base, $1 billion in liquidity, and a monopoly on a critical national security asset investors have been on a pretty wild ride.
Oh, definitely. The technical price action over the last year exhibits a classic high-momentum growth profile.
Right, in the 12 months leading up to February 2026, the stock rallied 340%. It had a 15-year high of $27.90 in January.
And naturally, a 340% run inevitably leads to some profit-taking. The stock subsequently pulled back about 30% from those highs.
Which is normal. But the structural trading patterns suggest consolidation rather than a breakdown.
Yeah, the stock is forming what technical analysts call a high-tight flag pattern. It's trading in a narrow sideways range as the market digests those massive gains and establishes a new baseline of support.
And we're already seeing the catalyst for the next potential breakout. On March 25th, shares surged 8.4% to $19.57.
That was directly reacting to the terbium production news, right?
Exactly. And that upward move was accompanied by a massive spike in trading volume when the aggressive 2026 production guidance hit the wire.
But diving into the underlying market psychology, the short interest data tells a very compelling story here.
It really does. Typically, after a stock runs up 340%, short sellers just swarm the asset. They bet that the parabolic rise is an unsustainable bubble that will inevitably crash.
But the data shows short interest has actually decreased by 3.2% recently.
Why is that?
Well, short sellers are fundamentally reevaluating their thesis because the company is actually delivering undeniable physical operational milestones.
Right. It's one thing to short a company trading on hype and forward projections.
Exactly. But it's incredibly dangerous to short a company that is actively producing a 99.9% pure terbium and sitting on $1 billion in cash.
So institutional sponsorship is naturally increasing. Analysts at firms like H.C. Wainwright recently raised their price target to $27.25.
And when institutions start raising targets based on execution, the remaining bears are forced into a very difficult corner.
Which creates the mechanics for a significant short squeeze. You have a shrinking base of short sellers who will eventually need to buy the stock to cover their positions.
Right, colliding with fresh institutional capital flowing in to capture the rare earth upside. If Energy Fuels continues to release positive operational news regarding their Phase 2 rollout, that dual-sided buying pressure could force some explosive upward momentum.
Now, moving beyond the immediate technicals, the broader macroeconomic tailwinds pushing this company forward are equally substantial.
Starting with a calculated shift in their corporate leadership. The company transitioned from their longtime CEO, Mark Chalmers, to Ross Papu.
Right. Mark Chalmers guided them through the complex engineering and regulatory phases to get the White Mesa Mill into this unique position.
But transitioning to Ross Papu signals to the market a fundamental shift. They're moving from the building and engineering phase to the commercial scaling and aggressive monetization phase.
They are positioning leadership to close the valuation gap and accelerate commercial contracts. And this leadership shift is happening at the exact moment the entire world is realizing it faces a massive power deficit.
Oh no, the AI power deficit, yes.
We are tracking this huge macro trend right now, the collision between artificial intelligence and nuclear power. Technology giants like Microsoft and NVIDIA are publicly acknowledging that you simply cannot power the AI revolution on intermittent wind and solar alone.
You really can't. The physical reality of AI data centers is that they require immense, continuous baseload power.
Right, a data center cannot power down simply because the sun sets or the wind stops blowing.
Exactly. And nuclear energy is the only source capable of providing that uninterrupted, carbon-free baseload power at scale.
So as these tech giants invest billions into their own power infrastructure, including initiatives to restart dormant nuclear plants, the demand for domestically sourced, secure uranium is skyrocketing.
And Energy Fuels is perfectly positioned to capitalize on this AI-driven energy boom as a primary U.S. supplier.
It is incredible to watch a Silicon Valley tech narrative directly drive the economics of a mining facility in Utah.
It really is all connected.
But our analysis also highlights an entirely different, highly specialized revenue stream forming quietly in the background. A recent update mentioned a third pillar for the company: medical isotopes.
Oh, this is fascinating. Processing uranium and thorium naturally involves managing radioactive decay. The natural decay chains of these elements produce specific isotopes, like radium-226 or actinium-225.
And historically, these were just complex byproducts he had to manage safely, right?
Right. But the breakthrough is that these specific isotopes are now highly sought after in the pharmaceutical industry.
For targeted alpha therapy.
Yes. Advanced cancer treatments that attack tumors at the cellular level with minimal damage to surrounding tissue.
Now, while this medical isotope initiative is currently unpriced by the market and lacks specific near-term financial projections, it represents exceptional blue sky optionality.
Totally. By harvesting these isotopes from their existing chemical processes, they are essentially extracting a high-margin third major revenue stream.
One that operates entirely independent of the cyclical uranium and rare earth markets. So we have mapped out a wildly bullish scenario here. The stored uranium revenue, the billion-dollar liquidity shield, the irreplicable White Mesa monopoly, the short squeeze mechanics, the AI nuclear demand, and even cancer-fighting isotopes.
It sounds almost too good to be true.
Right, which means our responsibility today is to scrutinize the risks just as heavily. What could realistically derail this $1.9 billion valuation model?
Well, digging into their 2025 10Q filing, the primary risk isn't market demand. It's a physical operational bottleneck at the mill itself.
Right. The chemical reality of the current plant configuration at White Mesa is that it cannot process conventional uranium ores and monazite sand at the same time.
And monazite sand is the raw feedstock for rare earths. Processing it requires aggressive acid baking and caustic cracking.
So it utilizes completely different chemical parameters and leaching agents than standard uranium processing.
Exactly. Because the chemistry clashes so severely, you can't run both materials through the same circuit simultaneously. They're forced into what the industry calls campaigning.
Campaigning, which means they have to run a batch of uranium, completely shut down and clean out the circuits, reconfigure the chemical flows, and then run a batch of rare earths.
Right. And this physical bottleneck means that the massive continuous profitability projected for the rare earth segment will likely face delays.
Because they need to build dedicated separate circuits to run these materials in parallel.
Yeah, which means the real revenue explosion might be pushed out to 2027 or 2028.
And that delay exposes them to a distinct variable: commodity reliance.
Right. If they are relying on the cash flow from the current uranium upcycle to fund the ongoing build-out of these dedicated rare earth circuits over the next 2 to 3 years, they are vulnerable to a drop in uranium prices.
So the spot price crashes, the cash engine funding the expansion slows down, potentially delaying the rare earth rollout even further.
Exactly. A uranium price crash is the cornerstone of the bear thesis.
However, practical risk assessment requires us to look at how the company would actually survive that scenario today compared to, say, 5 years ago.
Which circles back directly to that $927 million working capital buffer.
Right. If uranium prices compress and their operating margins shrink, they don't have to halt construction or dilute shareholders to keep the lights on.
No, they have nearly $1 billion in pure liquidity to absorb that shock.
They can weather a multi-year commodity downturn and continue funding the physical separation circuits needed to solve those operational bottlenecks without ever approaching insolvency.
The balance sheet acts as an impenetrable shield for the long-term vision. Taking all of these factors into account, the underlying cash generation, the unparalleled liquidity, the strategic regulatory moat, and the highly specific operational risks, the comprehensive analysis yields an 8 out of 10 bullish score.
So distilling this down into an elevator pitch for you, Energy Fuels presents a mispriced multi-year holding opportunity.
Yeah, they are actively leveraging a true monopoly asset in the White Mesa Mill to become the sole Western provider of highly critical heavy rare earths like terbium.
And this isn't a speculative venture built on predatory debt. It is a physical transformation funded by a functional uranium engine and protected by a massive cash fortress.
As we conclude this analysis, consider the long-term geopolitical implications of what is happening at White Mesa. For decades, the West has been entirely dependent on China for the materials required to build our most advanced technologies.
We've essentially been begging a foreign rival for the building blocks of our own infrastructure.
Right, but if Energy Fuels successfully scales this operation, it initiates a total reversal of that global polarity.
Imagine a scenario in the near future where the United States isn't just self-sufficient in heavy rare earths, but becomes a net exporter. dictating supply to our Western allies.
It fundamentally alters the balance of power in the global tech and defense sectors.
The question you have to evaluate as an investor is whether the broader market will fully wake up and price in the reality of this geopolitical shift before that commercial rare earth rollout hits full scale in late 2026.